This is Cece. Welcome to the Orbit. It is Monday, March 11th. We've got stocks down to begin the day. We're about 10 minutes into the trading day. We're looking at SPX down almost 0.25%. That's a follow through from Friday's sell-off. And Friday's action was a little wild. We opened up higher in the morning, looked like we were going to rip higher up to about that 5,200 level in SPX. Found sellers. Sold off pretty sharply intraday, tried to make some rallies, failed, finished kind of near the lows, and then we are following through on Monday. You look at that weekly chart, and it's sort of interesting. That was a very volatile week. We saw lows as low as about, let's call it 50.40 on the downside. We saw highs up near 51.80, 85, got close to that 5,200 level. Now you look at the expected move for this week. We are looking at a 1 week chart, and we have about a 1.3% expected move, and that takes us down to about 50.40 on the downside, 51.80 on the upside. So, you could safely say that, maybe using the 5,200 and the 5,000 level as a cheat code for those big round numbers on the down and the upside. And obviously that makes sense. We're right near 5,100. Now it's interesting. We're looking at that volatility this week, and it's almost 17 IV. And that is something to keep an eye on. You look through here, look at the days this week. It is 21 IV there, and it's 20 IV today, 21 IV tomorrow, 18 IV, 17, 16, almost 17 into weekend. That's as high as we've seen in some time. And there's a couple of reasons for that. One is check out the VIX. The VIX is now approaching 16, really, which is still below the historical mean in the VIX, but it is the highest we've seen vol since the fall. Really, since the end of October, beginning of November, we have not seen the VIX this high. So that is what these last couple of weeks of intraday volatility have done, which is really interesting because we're still up near the highs. You look at this, we have not broken this trend, this channel trend higher. But it's getting to that point where there's a little bit of nervousness. And if we did see a swoosh lower, expect to see vol pop, and you could see the VIX. If you saw a couple of ugly days that were, where we were down more than 1%, let's say, and we were having 1% swings last week intraday like it was nothing. So the market does feel like it has opened up a little bit volatility wise. And if we saw a couple of days like that in a row, don't be surprised to see vol and to see the VIX up near, say, that 18, 19 level. Now, going back to this week, this is income from options weekly, which we do Monday. We want to check in on all these levels. And obviously, we just talked about those levels for the week. For the day, we're looking at about almost, let's call it 0.4% expected move. This week is an interesting one because it's a lot of economic data coming out. So we're getting towards the end of earnings season. We have Oracle, we have Adobe, we have a couple of interesting names this week. There's some retail names still to go, like Dick's Sporting Goods and things like that. But the real story this week is going to be inflation data. We have CPI, then it's followed by PPI. We have retail sales this week, which will take on some added importance with what's going on with the consumer. And then it's followed up Friday with a University of Michigan consumer sentiment number. And then on top of all of that, it is options expiration for March. So on Friday, we will see the big expiration of March. And that will be interesting to track because if the gamma is getting taken out at these low vol levels into expiration, meaning the dealers, the market makers are suddenly short vol into that expiration. And let's say you've got a lot of traders, both institutional and retail, reaching for, say, puts or upside calls, with what's going on in NVIDIA and SMCI and the whole Bitcoin space and everything like that. All of a sudden, that could cause you could see some wild swings into expiration. Now, the flip side could happen as well, where all of a sudden we find ourselves near a big round number of 5,100, let's say, and the dealer books suddenly are flooded with sellers after the CPI, after the PPI, maybe they come in better than expected or normal and the market doesn't make much of a move, then the opposite could happen and we could see ourselves kind of have a bout of volatility for a week and a half and then kind of go sideways as everybody turns around to sell those options that they might have paid up for out of nervousness or euphoria or whatever it is. So let's go to the trades today. We'll look at first, let's look at an iron condor for today just to kind of get a sense of the levels. And let's go through here. We're looking at, on the short side, short call 51.30, short put 50.85. And that gives us about a 175 max gain. Go a little bit wider on that. Let's get this down to about 100. And we are looking at the 50.75, 51.40. Again, with the way the market has been whipping around, you look at this, zoom in on this, look at where that call strikes are on the upside there. I mean, that the market was making moves on Friday like that in 15 minutes. So you have to be very careful. This might be the type of time where you really have to be looking at defined market. If you are trading short duration over 0 DTE or 2 DTE, you've really got to be backing up the chart a little bit, even a couple of weeks, and looking for very strong support and resistance levels. The intraday ones are still tradable, obviously, but it can get through you really quick. Sort of triggering, I'm sure on Friday there were a ton of stops triggered. Now let's go back to the weekly. Again, we've got about this is almost a 50-50 in risk reward, and we're looking at the short put level of 50.45 and then the short call level of 51.75. Now let's take this and sort of put it closer to that 5,200. Let's just go all the way out there and see what's up. So that's that 5,200 level to the upside, and the 50.20 level, so pretty close to that 5,000. And you could actually get this down so that your short strikes were 5,000 and 5,200, which would be some interesting strikes, let's say, from a big round number and historical level. But again, anything like this, you've got to get through the CPI and the PPI and everything else this week. But sort of interesting, and you look at the 1 month, let's look at that on the 1 month chart. You can see where we are there. It's sort of like just up above the highs, which were Friday, and then down below the last 2 weeks, really. You're clearing those lows and you're back down near 5,000. So an interesting thing to look at, and obviously trading intraday and day to day. These swings are bigger the last couple of days, and so you kind of have to change your mindset slightly if you're a premium seller. Now, the other interesting thing, obviously, we talked about this a little last week, is if you're a premium buyer, intraday, you get a move down 50 points in the SPX, and you're looking to position for it to go back to unched or back to its recent highs over the span of several days, you are still not paying massive vol. And if you're doing it in the form of a debit call spread or a debit put spread, positioning for a 50 or 75 or 100 point move in the SPX, or a couple of point move in SPY or Qs or IWM or whatever the vehicle may be, you are still not being penalized for high vol. And then on the single stock side of things, it's the same thing. A lot of these companies have already reported, right? And that means they naturally, seasonally, after that earnings report, their volatility is low to what it was just going into their earnings. So, you're seeing some big stock volatility. I mean, you think about like what Apple has done the last couple of weeks, even like, so some of these big mega caps, Microsoft's moving around. Some of these names are moving around and their vol is quite low historically. And that's sort of reflective in the VIX still only being 15 and change. So if you are positioning directionally, or if you want to hedge, options are still pretty cheap. If you wanted to hedge some of these positions, if you had a situation where, like an Apple, where it sold off a little bit and you wanted to take a shot from the long side on a stock like Apple, look to the options market, look to some of those debit call spreads in a situation like that. If you're going to hedge anything outside of, say, Nvidia or SMCI, but some of these other names, like even in a Broadcom just reported its volatility is lower. It didn't move that much on earnings. It actually moved less than what options were pricing. That's an opportunity to potentially buy a put spread in AVGO. It's going to be very expensive because it's $1,000 stock, but you could sort of figure out maybe some tight out of the money put spreads that might be helpful if you were long that stock and it started going lower. So anyway, the backdrop is volatility is ticking higher, but it is still historically low. You haven't missed a chance if you are going to position directionally. Now, if you're trading short duration and you're a premium seller like 0 DTE or 2 DTE or weekly stuff, you got to be careful. These intraday swings have been pretty nasty. We're seeing it as I'm speaking. The market just went down, 1/4%, like it was nothing.